Hi, everyone. Welcome back. I'm Bill Gebhardt, founder and executive director here at 10 Dynamics, and I'm happy to share the latest episode of our podcast, Thoughts from the Machine. Today, we're going to recap our model's views on January 2025, looking at standout market moves and shifts in trends. We'll then see a familiar face in our Chart of the Month segment and finish up with our proprietary research showing trend strength by sector. Here we go. Just like last year, ags continues to be where all the action is on both the bullish and bearish side. On the long side, coffee, which we covered last year, has continued flying higher, surging 40% above its previous all-time high from a decade ago. Cattle prices, which we haven't really covered here before, has been in a strong, continued uptrend since September last year, and is now 25% higher than their historical highs made in 2014. A few weeks ago, we posted on social media that the S&P index, Bitcoin, and gold were all in similar consolidation phases, and that our trend strength remained high in these markets. Gold has in fact resumed its strong uptrend, marching still higher. We're still expecting the S&P index and Bitcoin to follow suit as our model's trend strength remains high for both. On the bearish side, orange juice registered a negative trend on January 31st for the first time since January 2021 and has since plummeted. It looks like after its meteoric run, it now appears that the OJ high is in place. Cocoa prices have also declined, but our model is hanging on to a very moderate uptrend here. So unlike OJ, we can't conclude that this bull market run is over yet. Cotton is another standout ag market, but in a strong downtrend for many weeks with no sign of reversal yet. Finally, we noted last month the Canadian dollar's downtrend could be ending as our reversal probability reached its max level. It has in fact rallied strongly off the low it made at the end of January. It might not mean the bear market is over yet, but it's worth looking for signs of a new uptrend in the coming weeks. Now our chart of the month. It's coffee. As we mentioned above, it's far above its previous all-time high and going up in a nearly parabolic manner. Last year, as cocoa and orange juice reached their highest levels, our model registered reversal signals, which correctly predicted a large consolidation in the case of cocoa and what appears to be the bull market high in orange juice. Right now, coffee is registering the strongest possible reversal probability. That would suggest to us that the bull market's days are numbered. And now for our proprietary trend strength indicator by sector. Despite all the excitement in the ags and soft sector, the average of the trend strength is currently near zero because of the spread of bullish and bearish markets. The oil complex continues to meander in a range that's lasted for nearly 2 years with no sign of a breakout. Historically, long periods of no trend have preceded some of the large moves we've seen in the complex, so oil is an area to watch for breakouts in 2025. Like ags, EU Energy's low trend rating is masking the strong bull trend in gas prices in Europe because of the rather trendless regional power markets. The last several months, we've pointed out the strong trend in the dollar versus all the other major currencies, and that trend has continued through the start of 2025, with the only exception so far the bounce in the Canadian dollar in the last couple weeks. Crypto is quite interesting right now. We only track Bitcoin and Ethereum, and the net trend strength is neutral, with the uptrend in Bitcoin being offset by downtrend in Ethereum. So here we have a divergence in the main coins. At the same time, speculative meme coin frenzy has been going crazy. If there's any analogy with the stock market, when you see major market index divergences accompanied by a speculative frenzy in some small area, you might conclude that it's a warning sign of a top coming in crypto. Finally, strong equities and low VIX continue to be supportive of the widely reported bull trend in U.S. equities. For today's Under the Hood, we'll talk a little bit about our trading philosophy, asking why are we trend followers? In my mind, I think you can generalize most active strategies into two categories, either trend following or mean reverting. Mean reverting is quite broad and covers everything from fundamental trading to arbitrage to correlation and short volatility strategies, just to name a few. It's based on the idea that prices are temporarily out of line because of psychology or market forces, and that prices need to return to normal, either measured by some quantitative or fundamental value. It's quite intuitive to many people, especially quants and academics who believe strongly in market efficiency. It's also shown to be successful across a wide range of strategies since active investment management started. Trend following, in contrast, is simplistically exactly what it says on the tin, making investments based on the belief that a market in motion is likely to continue in motion in the same direction. Now, this flies directly in the face of much of finance theory and shouldn't really work, according to many quants and academics. But in order for it to work, it requires that collectively people make consistent errors in forecasts and fail to anticipate what should be predictable. These ideas are intuitive to many traders who base their strategies on market psychology and human behavior. Trend following has also been shown to work consistently across decade-long market cycles. So which is better? I don't think you can say which is better, but the important aspect to me is which approach fits your preferences for risk versus return. Very generally, I would say that mean reverting strategies tend to have generally positive returns offset by a few large losses, or technically, a negatively skewed distribution of returns. Some risk-return metrics like Sharpe ratios, which use volatility to measure risk, can be quite high because of the frequently positive returns. However, drawdowns also tend to be quite high, and when the few large losses do hit, historically there have been some famous financial disasters caused by this effect. In contrast, trend following strategies are the opposite. They tend to be more frequent small losses offset by a few large gains or a positively skewed return distribution. Risk metrics like the Sharpe ratio might be more moderate than some mean reverting strategies, but a good trend following strategy should have a very good ratio of return to maximum drawdown. Having had experience with both approaches at 10 Dynamics, we use trend following strategies mostly because we have a strong preference for the characteristics of the return streams. Again, while not objectively better or worse, the portfolio outcomes fit with the risk-return profile which our clients and our team prefer. Okay, well that's a wrap for this month. If you're interested in systematic trend following investment, head over to our LinkedIn, YouTube, or Spotify pages to make sure you're receiving all of our latest content and ideas. Earlier this week, our new fact sheets were delivered to those investors who are already on our monthly distribution list. And if you're a professional investor and you'd like to receive our data going forward, please contact us at inquiries@10dynamics.com. As always, thank you for listening and see you next time with more Thoughts from the Machine.